Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gertis, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Recon Group at West USA and the Frederick team with Fairway Mortgage. NMLS number 625918.
So a leading topic that's going on right now in the real estate industry is creative financing. Everybody has questions about how they can get into a home with the least amount of money out of their pocket, or how can they benefit from yesterday's interest rate, or how they can just essentially just pivot or have the least amount of liability as possible. And so, it's something that's kind of gone viral. You've probably seen some stuff out there with Pace Morby. Then, of course, we talked a little bit about Dave Ramsey, who's on the complete opposite end of the spectrum last week. But really what I wanted to focus on today is leveraging other people's money, okay? Right now, first-time home buyers, they average about 6% out of pocket when they purchase their first home. Home buyers that are purchasing their second home or more, they're coming up with an average of about 13%, so more than double. Okay, and so I see these numbers and I'm sitting here like, wow, because I remember when I first got into the industry back in 2002, the big craze was the 80-20.
Yeah.
Right. So they would
such
do
a big thing, right? I
right.
mean, yeah.
And then stated income loans or no income, no asset loans. And then, well, we all remember what that did to our economy when things came tumbling down and whatnot. But there was 100% leverage going on, right? So they were doing that, and we were also doing a lot of creative financing back then, particularly for our folks that couldn't afford or couldn't get approved. We were doing lease purchases. We were doing lease options. We were doing all those things.
A lot of subprime, yeah.
Yep. There was a lot of subprime going on. And then now, fast forward, it's all kind of the same stuff, but they're just calling it different things, right? So right now you have DPA programs, you have lease purchases, lease options, carrybacks, wraps, subject twos. You have all these different things going on. And so I wanted to get your take on the financial, because I know over here on the real estate end, everybody's excited about it, right? Because first of all, everybody loves to not use any of their money or the least amount of their money as possible. But then they're excited about it because it's new information for them, right? So what are you seeing over on the financing side that's affecting all these things? What do you foresee happening with it?
We do have a lot of DPAs right now, a lot of DPA questions. I feel like that's the number one question when people call in. What kind of down payment assistance program can I get? What do you have available? And the problem is right now with the down payment assistance is from one day to the next, there could be 5 programs available today, and tomorrow there could be 1. So it's very inconsistent, and it's all based on premium pricing. And when I say that, it's higher rates on the rate sheet, because all down payment assistance programs typically come with a much higher interest rate.
Why is that?
Basically, it's a way for them to get their money back that they're giving you.
Nothing comes free.
Nothing in this world is for free. So there's a cost for everything, but you're getting to keep that money in your pocket. And some of these down payment assistance are incredible programs. Like one of my favorites is Home in 5. They now have 7% grants. You just got to be within Maricopa County. The interest rate's still pretty darn good. It's pretty close to what your standard rate is out there, but they come with higher fees as well. And some of these loans now, some of these DPAs aren't truly DPAs, but it's a first and a second where you're repaying the second mortgage on a monthly basis. Still a good option if you don't have any money to get you into a home. I mean, just like we were talking about Dave Ramsey a couple weeks ago, just get in a home right now. Saying it's a good time to buy. Well, why is it a good time to buy? Because if you have the option for a DPA, get in right now while you can with a DPA, because eventually all this creative financing isn't going to be accepted, right? Mm-hmm. We know that. Once the market,
sellers aren't going to accept it.
That's what I mean. Yeah.
Oh, okay. Yeah.
Yeah, they're not going to. Why would they accept creative financing when they have a conventional 50% down,
or even cash buyers?
Or even cash buyers.
There's still a ton of them out there. It's funny. We always say money doesn't disappear; it just moves. But even though with higher interest rates, we're still seeing and quote unquote softening of the market, which apparently is a thing, but not here. We're seeing people still going out there using cash because there's still tons of confidence in the market.
Yeah.
Even though interest rates are going higher, which historically means that less people are putting money into the securities market. It's because the rates are going up.
Right.
Right. And so that's just not happening here. So I guess to kind of go to bring things full circle, what do you think is going to happen to these sellers that have sold their home and did some creative financing? They maybe they did a carryback over to a buyer. They sold their home for $500,000. They had a loan on it for $300,000 at 3%. Then they carried it over to the buyer at 3% or even 3.5% to do kind of a blend rate. And then they want to turn around and buy another home. What are some potential pros and cons with that?
Well, a lot of the pros with that is, you're making money financially on your money, and I've seen some of these seller carryback loans at 10%, where the seller is giving $175,000 at 10% to a buyer, and absolutely, that's you're making a killing. Plus, your money is going to be there. Plus, you're holding a lien on the property. It's great. Now, when you're going to buy another property, obviously you're not going to have as large of a down payment for the house that you're looking at buying. But if let's say you're coming up with 5% of your own cash and you're paying a 6.99% interest rate, but your 175 is at 10%, all day, rolling with it. You're winning. We have seen a lot of seller carrybacks recently, and actually had a few buyers with some seller carrybacks that they get me involved and tell me what should I get the interest rate at, and it's like everything's negotiable when you're talking to human beings, especially to human beings that aren't involved in finances very much. And I was able to get a guy 5% interest rate currently on a second mortgage on a carryback with no balloons over 30 years. That's huge.
That is huge.
You couldn't even get a home equity line of credit, even with stellar credit and a ton of money in the bank at that.
They're about 8 to 9% right now in HELOCs. Yeah. So if you want to have more intelligent conversations about financing, creative financing, pros and cons, consequences, upside, go ahead and text the word money to 623-AZ-RECON. That's money to 623-AZ-RECON. So talk to me. Here's one of my questions, because I'm very well versed with lease purchases and carrybacks, so on and so forth. We've traditionally always used lease purchases over at the Recon Group because there's an actual lease in place to where we can actually offset debt so that our sellers can turn around and still have that availability of funds and availability of income in order to qualify for their next loan. Talk to me about the carrybacks and the ones that don't have leases associated with them.
Well, if you have a carryback and you don't have a lease associated with it, we got to see 12 months payments of that carryback in order to use those funds or that income for a new purchase. And there's no exceptions to it. So even if you're at 10 months, we wouldn't be able to get an exception to use that income. It doesn't even matter if you claimed it on your tax return. We would have to show 12 months deposits from that note carryback. Does that answer your question?
Yeah. So ultimately, if I'm a seller and I carry back, or if I'm lending money to a buyer, I need to be prepared to show additional income if I want to turn around and buy another property that's getting my debt to income up to 40-45%, right?
I'll say this: most people that do seller carrybacks, they typically aren't struggling on debt to income ratio purposes.
Okay.
Well, from what we see, and I would say that's 9 out of 10. Typically, they have the money to loan to people, and it takes money to make money, right?
Sure.
So when they're able to get the nice note rate on their carryback, it works out well. And typically, we don't even need to use that income from that note anyways. But you did say something. You said like a lease to purchase. Mm-hmm. In a lot of cases with those lease to purchases, we get a lot of buyers that ask about lease to purchases, and a lot of times those buyers are signing lease to purchases when their credit health is horrible.
Right. And that's typically the scenario. Like if we have a buyer and maybe their credit score isn't quite there, or if they're a 1099 employee,
yeah,
and they need a little bit of time for their money to really start kicking in on their 2 years or even their 1 year, they'll use a lease purchase option so that they can go into escrow now, lock down a price possibly, and then close in a year's time. But then in a year's time, they're leasing the property from the owner.
right.
And then that owner is, they're usually making sure that they're cash flowing, but then that buyer gets to have possessive rights plus equitable title to the property at the same time. So during the course of that year, they have part of that lease going towards their principal, generally speaking.
Yeah.
But then because they've locked in a price, if the value goes up, they can turn around and sell it at the end of the year before they've actually taken full on title, sole, and separate.
Majority of the people that we see with credit issues aren't actually following the plans that we put in place, because they're almost like, I'm already in the home. They don't understand that there's a contract to, hey, you have 12 months to get in here. You need to work on that credit. Now, the self-employed, the 1099 borrower, that's typically what I see. I love the lease to own option for them, because they understand I need to have this to qualify. I know what I need to claim as income, basically, without us coaching. But they know what they need to do in order to get there. I feel for the people that are in hurting in credit in order to qualify for that purchase, because typically I see the owners winning in most situations out of that. You know what I mean?
Well, yeah, but to play devil's advocate,
Yeah, please.
Typically the bank, the higher the risk, the higher the interest rate.
Of course.
Right? And so why shouldn't I, as an owner/investor, not do a lease purchase over to a buyer that is suffering from credit and charging a higher rate?
I don't see anything wrong with it. I don't. What I want our listeners to know, if you're that person in credit that's having had credit damage or some sort of derogatory in the past, you just need to make sure that you've already been in touch with the lender before you get under those types of contracts. Make sure that you have the plan and you follow the plan specifically with no variations to the plan, because that can highly affect if you're going to be able to make this happen in that period of time, whether it's 1 year or 3 years when you have your lease to own. Does that make sense?
Yeah, it does.
Yeah,
it does. And this has been really eye-opening, because when we were preparing for this and we were having discussions about what does creative financing entail, because on the real estate side, we've been doing it for years, decades, right? And this is more commonly a practice in either raw land or commercial. You see these types of creative financing happen all the time and have since pretty much the beginning of time. It's just now it seems like it's more popular that it's being used on a residential front, right? And so it's just interesting to see how lending institutions are pivoting along with the times, because it's new stuff. You guys, it's just something that you guys are going to be looking at more and more whenever you're doing an analysis on whether or not the underwriter is going to stamp this loan doc or not.
Yeah.
Right. And so I'm really interested to see what your thoughts are as far as what you see in the next few years, if there's going to be any differences in loan programs or procedure or policies or anything like that.
Well, typically when we start to have like some sort of downturn in the market or a slowdown, typically things get more restricted. There's creative things that come out, but typically your main products become more restricted. And we've seen that some of the automated underwriting systems grade levels have increased on what you need to have and what kind of extenuating circumstances you may need to have in order to qualify for something. And we've seen the loan level pricing adjusters adjust to make it more expensive, possibly for higher qualified buyers. But I do see more creative financing come out. I mean, just in the past couple of years, DSCR loans have been such a a huge thing recently. We've seen, we just partnered with Knock. So we're going to be starting to do some of those bridge loans, which a lot of people aren't going to be taking advantage of right now, but when the market turns, that will be a huge partnership for us. We've seen ITIN numbers, bank statement loans they were there before, but they've really just kind of come out. And we've started seeing people use renovation loans. You started seeing people do construction again on their own, rather than going after new build communities. You've seen a lot of manufactured properties come back around. There's all kinds of things that we've seen, and I feel like as we use those products more, because they're private money, in a lot of cases, I feel like they're going to be allowing for lower down payments. Again, because it's private money, so it's not government regulated products. I think that we'll see them come out with maybe 10% down DSCR loans. That would be huge. I mean, they already have a higher interest rate, but 10% down, that would be great. I do think that we'll see more of that stuff come out.
Man, I just love listening to you, learning from you. And I know that everybody else out there could really benefit from having a consult from you and your team, and especially when it comes to the creative financing, the way that we work together and the way that we've been able to really cultivate this partnership and help people amass wealth generationally and just build out their portfolio. It's awesome to be partnered with you.
100% agree.
Yeah, absolutely,
Appreciate
man. Text the word money to 623-AZ-RECON so that you can learn more and we can have a conversation. That's money to 623-AZ-RECON.
Thank you for joining us on the Real Estate 401k Show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623-AZ-RECON.